Oh, welcome. Hi, everybody. This is Andrew Sykes at Sykes Elder Law in Pittsburgh, Pennsylvania, coming to you live streaming on a number of different platforms. You might be watching us on Facebook, YouTube, LinkedIn, or a number of different platforms out there. So we're going to be talking today about the power of Roth. Roth IRAs and 401ks. And to put this into some context, mostly what we talk about in our live streams is estate planning. So when we're doing estate planning, we look at the entire context of the estate plan that we're working on for whatever client. And one of the things that's really important these days is what do they have in terms of retirement accounts? Because it's not unusual at all for people to have most of their wealth in some type of retirement accounts. And it's important to understand how those work, and in particular, if there are tax consequences. So, if they have accounts that are Roth accounts or traditional retirement accounts, it's important to understand how those work, so that if we're making plans to leave certain assets or accounts to heirs, how is that going to work, and how can we maximize the client's tax situation and get things to work out for them in an optimal way. So Roths have become really important, and I wanted to have this discussion with my special guest, Chris Cannon. He's the guy that I call whenever I have questions about Roth accounts in general or Roth conversions. And so we're going to talk about estate planning impact, but really about the whole Roth issue in general, and talk about how clients can get tax-free growth. So let me just take a minute and brag about Chris here. He's got a bachelor's degree in accounting and a master's degree in security analysis and portfolio management. I've known Chris for years. He's been in the financial field for many years and is currently the owner of Retire Right Financial Planning in Bridgeville, Pennsylvania. So welcome, Chris. Glad to have you here.
Thanks, Andy. Happy to be here. Appreciate you having me. This is probably my favorite topic. It touches base on the young and the old and the soon to be inherited. So it touches base on a lot of folks. It's a very important topic. Has a lot of tremendous benefits to it.
So. Yeah, that's great. And I'm looking forward to hearing your comments in detail. So to kind of kick us off, you and I were talking the other day, and you mentioned that, this is a really timely topic now. And if you can kind of expand on that as to why Roths are really important to talk about currently.
Yeah. We would say Roth matters more now than ever, predominantly because we have tax rates that are set to expire at the end of this year here. We're going to revert back to the prior tax rates. So we do know that if something doesn't happen from a point in Congress, we're going to have higher income tax rates in the not too distant future. So that's just part of it. Roth was once explained to me, do you want to pay taxes on the seed and not the harvest? The other thing I tell our clients is, do you want to pay taxes today and never again? So Roth is a really, really important tool to not just understanding today, but to really think about the future planning of what the purposes of those monies are meant to be for. They can be wonderful for many different situations, which we'll cover today. But I would say taxes are probably the most pertinent situation. When you have tax rates today, most of the clients we work with, there's varying tax rates, but nonetheless, they're going to go up several percentage points here in the not too distant future if something doesn't happen. If you're like me, I like to buy things on sale. So why not buy my future assets on sale today and not pay the higher tax rate later in the future, and even in the near distant future when tax rates go a little bit higher too. So taxes are a very important piece of this puzzle.
Yeah, that all sounds great. I like that idea of planting the seed. So if somebody is new to this area, doesn't know anything about Roths, can you kind of give us some basics? What do people really need to know?
Yeah, so what's been around for a very long time is pre-tax contributions. So typically if you're contributing to a workplace plan, whether it be a 401k or a 403b, or if you're self-employed doing a simple or a SEP or a traditional IRA, if you're just saving on your own because you don't have the ability to save through a workplace plan, those dollars go in pre-tax, meaning whatever contribution you put in at whatever level, whether it be $100 or $5,000, you get a deduction from your taxes. So if you make 100 grand, you contribute 10 grand. Well, now you only made 90 grand on your taxes. So you get a deduction at that current tax rate. Then those retirement plans, well, whatever you want to invest them in. So don't get sidetracked in what is a Roth in, because think of the retirement accounts as a room, right? Whether it's a pre-tax room or a post-tax room, 401k, 403b, whatever it has. You can invest in whatever you want. So you can be the most conservative investor and have a savings account that's a Roth IRA. You can be the most aggressive investor and have, Bitcoin ETF or stocks or bonds. It's irrelevant. It's just the structure and the room that it's in. So traditionally, the pre-tax offerings, which have been around for a very long time, since 401ks came around in the 70s, you would invest in whatever it is that you wanted to do. The growth of those assets would not be taxed as you go along. And then in retirement, which is typically beyond the age of 59 and a half, as you take money out of those retirement accounts to live on, you pay taxes on whatever that amount is worth. So I'll give you a very simple example. I tell our clients, if you get average stock returns through history, money doubles every 10 years. It's called the rule of 72. Stocks average about 7.2% annualized, maybe a little bit more, but we'll use that simple number. So if you have 10 grand, 10 grows to 20, 20 grows to 40, 40 grows to 80, 80 grows to 160. So if you're younger and you have 40 years, the 10 grand you put in is potentially set to be 160,000 future dollars. You took a tax deduction on those earlier dollars to get a full tax-free growth of that 160. And in retirement, when you go to take money out, whether it be $100, $10,000 or $100,000, it's like getting a paycheck. You have to pay Uncle Sam at that point. So those are the pre-tax assets, which most folks are used to and are aware of. And your company contributions, if you happen to work for an employer that provides you with a matching formula, is always pre-tax money. What's become very popular here in the last few years is what I call the Rothification of retirement accounts. So you have the Rothification, yeah, that's right. So this is the whole idea was started after a senator, I can't remember his first name, but last name Roth, hence the term Roth. But effectively, you can tell Uncle Sam that, hey, I'm going to pay my taxes today on that $10,000, okay, that we're contributing to the retirement account in this hypothetical situation. So whatever my tax rate is, let's say I'm in the 22% bracket, I'm going to put 10 grand in and I'm going to gross up. So on top of that, I'm going to pay taxes. It might cost me $2,200 to get my 10 grand put away. So it's going to cost me a little bit more to get that 10 grand in there. But the real true benefit down the road is that 10 grand that I put in there in 40 years, that 160 grand is totally tax free. So I don't pay taxes at all on the $150,000 of growth. So I paid $2,200 today to pay no taxes on $160,000 later. Even if tax rates were identical and the same, that 22% bracket in retirement, you pay 22% on 160 grand. That's a lot of money, right? So we're letting time, work for us and having those dollars grow tax-free. And that's only talking about the endpoint at retirement. At retirement, typically people tend to live an additional 30 years. So that 160 can potentially go to 320, right? And then 640. And then maybe you're blessed to be in a situation where you don't even need those dollars. Then your kids get those dollars. That 640 now becomes over $1,280,000.
And that's just $10,000 that you started with.
Correct. And no one pays taxes
in later years, right?
That's correct.
Okay.
Right. So, I look at Roths as a kind of a very timely situation just because tax rates are changing. It's a hedge against future uncertainty, right? We don't know where tax rates are going. It's, if you just look at tax rates over the last 50 years, we're at a pretty low point. And then it really provides something that most people don't think about until they get to us. And we specialize in working with clients that are approaching or in retirement. But if they're getting good counsel prior to that, you want to think about tax diversification in retirement. We'll have people come to us. I'll give you an example with $1 million. And they're like, yeah, I'm a millionaire. I have $1 million in retirement accounts. I go, well, that's true, but Uncle Sam's a partner for probably a third or a quarter of that versus $1 million in a Roth account. Well, you've eliminated Uncle Sam. You truly have $1 million and don't owe any taxes on that whatsoever. So, there's really three buckets in liquid assets, meaning, tangible dollars you can get a hold of pretty quickly. You can have after-tax dollars that sit in a brokerage account. You can have pre-tax dollars that you pay taxes on as they're distributed. And then you can have Roth dollars, which are totally tax-free whenever they're distributed. And we'll talk about that here in a little bit. So really important to understand what options you have available to you, understand where your tax rate is today, understand where your tax rate might be in the not too distant future or even in retirement.
I have a question on what you said so far. So if you're advising somebody that's young, as they say they're in their 20s and they're just starting out, is there one answer? Is Roth for everybody? Should everybody put contributions into Roth and nothing else, or does it depend?
I would step on a limb here and say 99% of the time, if you're younger, Roth would be outstanding. And I would tell you that would virtually fit for most folks until they start getting into their mid to late 50s. The exceptions would be if you just happen to have a very high income year and an abnormal earnings year where things just tend to be really large. And at that point, taking a pre-tax contribution for that particular year might make some sense. And let's talk about that too. If you're in a workplace plan, and there's a lot of misconceptions about this, you have no income limitations to contribute into a Roth, right? Most people are aware that if you make too much money, you cannot contribute to a Roth IRA. If you're under the age of 50, that contribution limit's $7,000 a year. If you're over 50, it's $8,000 a year. So just in that sense, if you make, the phase out starts at, if you're married, $236,000 and ends at $246,000. If you have a household modified adjusted gross income over $246,000, you can't contribute to a Roth as it stands. But that does not apply to retirement accounts provided by a workplace plan, 403bs, 401ks. You have the ability to still contribute to this Roth dollar. So it's very unique if you have a complex tax situation. But I would say for most folks, especially young folks that have the benefit of time, Roth is absolutely the way to go. If you fall outside of that income limitation on the traditional side, there are ways to make contributions to Roths. And that can be done through a transaction called the backdoor Roth IRA. So a little bit of a complex transaction. It's actually very silly and pointless, but I do it for a lot of our clients just to ensure that they're getting those Roth dollars put away. Because those Roth dollars, in my opinion, are gold. They're probably the best asset that you can have going into retirement, as well as passing along should you not utilize those. It's just a wonderful asset. So.
Yeah. Okay. So even if you're putting in less, even if you have $10,000 and that's it, even if you're putting less in because you have to account for taxes when you're younger, it sounds like it's still a better deal because you're getting tax-free growth on the years that follow.
Oh, most certainly. And then there's so many fun things you can do. Being very fortunate in the seat of being a business owner, you can do really cool things like, I have my children do certain things in the summers and have them on payroll, so they have earned income, and my 9 and 8-year-old have Roth IRAs right now. So if you do the future math of the contributions I put in for them, they're going to be set up. They might not have to ever contribute anything. So the earlier you start, you get the true benefit of time, and that's really the magic in investing. If you're just looking at basic S&P 500, which is the market. It's just time. The secret sauce is time, and it's compounding. It's that snowball going down the hill. You start at the bottom of the hill, snowball doesn't get very big. You start at the top of the hill, snowball is going to get massive, right? And Roth, just as it stands today, allows you to not pay taxes on the growth of those dollars ever. And they also provide a rather unique element of flexibility, which most people aren't aware of. Your contributions, since they're after tax, are always tax-free, and you have accessibility to them. So let's say, Andy, we put that 10 grand in there. Now you want to hopefully have a good financial planner and someone helping you and making sure you have a savings account. But, crap happens, right? Stuff happens. So let's say I blew through that savings account and things just aren't going so well for me and the family right now. And I've got that 10 grand that I put away in that Roth. And then let's just assume it's not a workplace plan with restrictions. But if it's in an IRA, Roth IRA, and 5 years down the road, it's now worth 20 grand. In an emergency situation, I can always access that 10 grand and I can pull it back out. Not that I want to do that because, it's money set aside for, the rate, long term, but you still have accessibility, and I don't have to pay any taxes or penalties on the basis what I contributed. Whereas if it were pre-tax, paying taxes and penalty to get that money out of there, and that can be a pretty sizable amount of money for most folks, just getting tossed out for nothing.
Yeah, they can kind of be the banker in a sense in that with that arrangement.
Yeah, it's just I like flexibility and options. So I can't tell you how happy it makes me that you have the ability to contribute those dollars totally tax free, but still have some, have them grow tax free and still have some flexibility to access them at some point.
Right. Okay. Well, as you mentioned, a lot of the people that you see and retire right, and that I see in my practice when people come in and we're talking about what assets they have, they're older, so they may have some in Roth accounts, but they may have traditional accounts that have accumulated over the years.
Yeah.
And I know there's a strategy for converting traditional to Roth IRAs. Can you talk about that and what kind of things people ought to think about?
Yeah, so you really want to have a really solid retirement plan when you get to retirement, even if you just have pre-tax assets. So there's a lot of different moving parts, and let's start just a basic age timeline. At the age of 59 and a half, you have the ability to get a hold of retirement funds without paying Uncle Sam a 10% penalty. Uncle Sam gives you the ability to go pre-tax or Roth and let those monies grow tax-free during those years, however long it may be. And in doing so, he says you got to leave it there, or if you take it out, you touch the stove and you got to pay a 10% penalty. At 59 and a half, that ends, right? So once you hit 59 and a half, you're good. And then you get to 65. And then there's a very important thing that happens there. It's called Medicare. That's traditionally what most people try to wait to retire until, or have some kind of plan before that. And then the next step in evolution in that is going to be Social Security, which you can start at 62, you can delay it as late as 70. And then beyond that, we have these things called required minimum distributions, which traditionally used to be at 70 and a half, and they've now gone out till 73. Required minimum distributions are when Uncle Sam says, hey, we gave you all these years of tax-free growth, whether it's pre-tax or Roth, you got to take some money out. And that amounts to be, let's call it 4%. And if it's pre-tax, you got to pay Uncle Sam some taxes. If it's not pre-tax and it's post-tax, well, that's irrelevant. You don't pay any taxes. You just got to start bleeding that account down just a little bit. But what we look at is all these varying components that happen, and we try to put in a really good plan in place so that, if you happen to have enough assets where you're not going to utilize all those dollars, we can create income and what I call fill up the buckets. So I like paying taxes at the lower rates. If you're somebody who has the ability to take assets out of the pre-tax buckets, we can convert them and maintain only that 10 and 12% bracket. And as it stands today, with the standard deduction, which most people utilize, you can have up to close to $130,000 in income in retirement, married, filing jointly, and not exceed that 12% bracket. So for clients that have the ability and have some money on the sideline to pay some taxes, because I like paying taxes on the conversions, which is what we're talking about, Roth conversions, you can take that money, convert it from pre-tax to Roth, pay Uncle Sam his money now, and even though you're like, hey, Chris, we're 65, right? We're no spring chicken. I would tell you you are. You don't go to retire or die, you got another 25 or 30 years. So it still goes back to, hey, even though you didn't have the ability like the 20 and 30-year-olds do today to contribute a lot of Roth because it hasn't been around that long, you can still convert, pay the taxes now, let that money continue growing for 5, 10, or 15 years. And if that money grows for its 5, 10, or 15 years, that's outstanding because that then gives you a potential bucket for long-term care, Andy, right? What does long-term care cost? Those costs are exorbitant, right? Whether it's 10 grand a month. Now, if you're paying 10 grand a month and you're pulling out of retirement accounts that are pre-tax, it's not 10 grand you need like 13 or 14 grand to net the 10 grand, right? Imagine if you had Roth dollars just sitting there, right? So those Roth dollars are sitting there. Now imagine you never touch those dollars and they go to the next generation. The next generation gets the money and they get it tax-free when they take the money out of there, right? So it's just a really good tool to understand where your tax brackets are and have a really good plan to potentially pay some forward taxes on those dollars and let that money continue cooking, whether you plan on using it or not. Again, going back to a hedge against future uncertainty and against higher tax rates.
Yeah, long-term care is so important for clients these days because they can spend much of their estate doing that. So it's one of the things that we always talk to people about. And, do we have a plan to pay for that?
Yeah.
And the current average in Pennsylvania, the Department of Human Services tracks this, and it's currently over $12,000 a month for nursing home care in Pennsylvania. For lesser levels of care like assisted living, it's less, or memory care, or whatever. But the average, that's just the average statewide is over $12,000 a month and seems to go up every year. So it sounds like it's a little bit different. Earlier we were talking about somebody who's younger. It's maybe a more straight ahead decision to say, well, if you're in your 20s and you're trying to decide, put it all in Roth. That's probably a pretty good.
You can almost bet on that one being good.
Yeah.
I will point out too. So you mentioned the cost of the long-term care. Imagine pulling that out of your 401k. Like, okay, you need 13 or 14 grand, you got to gross up. Now, there are some medical expenses that can be attributed to that. So that does help a little bit. And I will tell you, there's one thing, one client I found a very unique opportunity for, and we've seen this a handful of times now. So some of our clients will go into retirement communities that have transitional living, right? Where you buy in and you start off independent and then you kind of graduate, through the ranks as you need care.
Right. The continuing care retirement communities. Yeah.
Yeah. It's much more your world. But I found out just kind of asking some questions when they paid a hefty, they sold their house. That's a lot of times what happens. They sell their house and move into these beautiful places and just parlay the sale of the home into that. A large chunk of that upfront purchase was attributed to medical expenses. So that year, because of that one-time payment in and that medical expense, they virtually had no income. So we were able to take close to $100,000 from their traditional IRA and convert it to a Roth. And if memory serves me correct, I think their effective tax rate was still less than 10%, even with that large of a conversion. And those monies now have, more than 2.5x since we did that. So they paid virtually nothing from when they moved into that community. And now they have this giant bucket of assets that are completely tax-free that they can do whatever they want to do with, right?
That's a really valuable lesson. That's a good thing for me to pick up on when I'm meeting with people and they're talking about these transitions to see if they might have deductions that they can offset with something like a conversion. So that's something I'm learning new today. I hadn't thought of that angle before.
Yeah, it's really important, Andy, to have, we always say, a really good planning team. It's a three-legged stool. You get the attorney, you get the tax guy, and you get the planner. Those three can work together and chat out kind of the situation. You get some really tremendous benefits. And Roths are a huge component of what we do. And it's something we try to look at for everyone.
Yeah, team effort is really helpful.
Yes, yeah, very much so.
So in the world of Roth conversions, as I understand it, it's not maybe as straightforward as somebody who's young and deciding whether to do Roth or not. It's more complex because you've talked about the advantages of Roth conversion, but it's not always the right moves, and sometimes you have to decide whether it's correct. True.
Yeah, there can be some unintended consequences, because again, it's taxable income, right? So if you're not paying attention, you go, this sounds great, Chris. We're going to convert $1 million, move it over. Here we go. Well, in about 2 years, you're going to call cursing my name because you have these things called IRMA charges, income related monthly adjustments on your Medicare premiums, and your Medicare premiums just went from $187 today to $450 a month, right?
Ouch.
Yeah, that's right, and that's every month. So there's zones, right? So you can increase your income, you can bump it up over that 12% bracket, go up a little bit higher, but you definitely want to pay attention to your Medicare premiums if you're at that age. If you're close to Medicare age, because they do look back 2 years of that income. And then also if you're collecting Social Security, it's hard to not have your Social Security taxed if you have some other income, but if you don't, that's also something to be aware of. If you go over a certain income limit, 85% of your Social Security is taxed at your rate. So you pull one string, it does have some other things to consider. And I have clients that have willingly made very large conversions and just be done with it, and others that we kind of fly as close to the sun as we can without causing any additional and extra taxation. But this is something you should, if you're doing conversions, it has to be done by year end. So the best situation is, kind of work up a plan early in the year and then really revisit the numbers and consider doing that at the end of the year. Because once you do it, it's done. And you don't want any real surprises. So we do a lot of conversions kind of between Thanksgiving and Christmas when we have a big picture of what's going on. And one other thing that just popped in my mind, Andy, and I apologize for running on, we happen to have a nice correction in the market. A healthy movement is, 10, 15, 20% down, which we saw earlier this year. Really good opportunity for those young folks that might have some pre-tax assets to consider making a conversion. So if I did a conversion back in late March when the market was down 19%, I just got 20% of tax-free growth on those dollars now. So there are timely conversions that can happen based off market movements if you're invested in the market. And then one last conversion idea that I have for a lot of clients that work for companies. I mentioned earlier that companies do pre-tax contributions because they get the deduction. They're working on changing that, but you can always, well, not always, it might be a possibility within your company's 401k plan to convert those pre-tax dollars that they matched you at the end of the year. So you can truly have a full-blown tax-free Roth 401k. So, if you're putting 10% in and they match you up to 5 on 50%, it's a 15% contribution. Instead of having 2/3 being Roth and 1/3 pre-tax, if you wanted to pay the additional dollars, you could convert that if the plan allowed. So, so conversions can work for folks that are close and in retirement. Conversions can work for folks that are, at end of life. They can also work for the younger folks. So it applies to all.
Yeah, all the more reason to work with an expert, somebody that would know this and be able not only just to spot that issue and make me aware of it,
Yes.
but also to work with me to make sure that I do it right and I'm going to get the result that I need. So I think this might be a good time to bring up this. This is one of your charts that's available on your Retire Right website, and I love it because the topic is should I consider doing a Roth conversion? And even if you don't read through it all, you can kind of see the complexity of it, and on whether people are watching this on a full computer or laptop or phone or whatever. Not everybody's going to be able to see it. And I don't intend to go through it in great detail, but it just kind of shows. You start with a simple question like, will you need distributions from your retirement accounts to fund your retirement plan? Yes or no, and then you go in different directions through this decision tree.
Yeah, I'm a visual learner, Andy, and we have a whole bunch of these on our websites that pertain to different items. But this is a very easy way for someone who might feel like you just don't understand the topic, aren't quite sure the questions to ask. There's a lot of confusions, even on the simple things like, can I invest in a Roth? Yes. Roth's just the shell. You can put whatever you want inside that shell. So these flow charts really give the ability to kind of walk through the decision tree and kind of get you to a point where you realize, hey, yes, this is complex. Yes, this seems to apply to me. Maybe this is something I should discuss with my attorney or my accountant or my financial planner.
Yeah, great. So one of the things that I would like to see if you can touch on, because this is near and dear to my heart, is Roths and estate plans. And you mentioned that a little bit earlier, but I wonder if you can go into a little more detail about tax-free inheritance for heirs and how people can make the most of that.
Yeah, so there used to be this, if it's inherited a retirement account, I hate to say this, but they keep changing the rules so much, it gives me a job. If they ever simplify things, well, although I don't know, with the artificial intelligence these days, it might still put me out of a job. But nonetheless, the more complex it is, the better for me. But they keep changing the rules, right? I mentioned there were required minimum distributions at 70.5. They're now 73. When you inherit a retirement account, the person that inherits that asset is super important. If it's a spouse, they get, again, there's some still decisions to take there. That's a little bit more even. They can assume it or leave it as an inherited depending on the age. If you're younger, that's very, very important. But let's just assume that you're not a spouse and you're a child and you inherited your parents' retirement account. Previously, you got to stretch that, and they called them a stretch IRA, those assets over your lifetime and take required minimum distributions based off your age. That was really cool because the account just kept growing. It could be invested and you would take 2, 3, 4% out, whatever it is. And if you needed more, you could take it out too. Well, the government wisened up, and as everyone listening is probably aware, they don't run the best budget and don't balance things too well. They said, how can we get a hold of tax dollars? And again, just as a small sidebar, I think this is one of the reasons why Roths are extremely safe, is because the government's always looking for money. What you're doing is you're telling the government that, hey, I'm willing to pay this off right now, the taxes. It's another reason why I don't think Roths are going anywhere, because you're just paying the taxes now, putting more money in their coffers, and they're willing to take that. But what you're looking at is if you inherit a retirement account, you have 10 years to close that account out. So you have to take required minimums now. They just changed that on an annual basis, but that account has to be closed in full by 10 years. So if we think about most situations, parents die in the 80s, kids are typically in the 50s or 60s at the peak earnings years, and they're in a high tax bracket, the highest income they've made, and now they get mom and dad's retirement account, which is taxable to them as they take it out, and it's layered on top of their income. It can be a pretty ugly situation where Uncle Sam just gets a ton of money, right? So having the foresight to think about, maybe I don't want to give my well-to-do children these pre-tax assets. Maybe I can convert them. And that's the other thing we do too. We got a lot of little old ladies here who have very successful, or little gentlemen, whoever you want to call it, have successful children. And we're doing conversions at their rates, setting it up, knowing that they're not going to spend it and it's going to go to their kids who are successful and make a lot of money. So we're paying taxes even at the 10, 12, and 22% bracket and letting it grow just so their children in the 35 and 37% brackets get the money tax-free. Because what happens with the Roth is you still have that RMD for the beneficiary in that 10-year window, but as those dollars come out, they're not taxable. So again, going back to that earlier example, $1 million pre-tax is vastly different than $1 million Roth. So imagine getting $1 million, and I know we'd all love to inherit $1 million, but having to pay taxes on over 100 grand layered on top of your income every year. It's awesome and it's great and it's wonderful for everyone, especially Uncle Sam. If we can get ahead of that, we can eliminate Uncle Sam and cut him down a good bit so that you truly get that $1 million in your pocket.
And then I think there are also those other beneficiaries who fall into some category like being disabled or chronically ill or minors or something like this, where they can stretch it out over many, even more years. It might be, 30, 40 years. Yes. And that would add to all of the compounding.
Yes, very much so. There's very little downside if planned appropriately. And again, conversions can apply for, the 20-year-olds all the way up to the 80-year-olds. So it's a very, very important topic from contributions to conversions that everyone should be looking at and having, an educated discussion with their counsel or advisors on, does this apply to me? And if so, how should we consider looking at it?
Right. Okay. I want to change gears a little bit and see if we can talk about some common mistakes and pitfalls that people should be looking out for as they're entering this world.
Yeah. So, one is not paying attention to Medicare premiums, right? That IRMA. So if you have too much income, you can, throw yourself a little bit of a wrench and not realize that you bumped up your Medicare premiums. Again, taxable. So that's number one. A really, really, really big one that's come up, and I'm going to read off a page here just to make sure we get it totally correct. Roth 401ks have not been around a very long time. So we're starting to see some issues creep up with folks that contribute to Roth 401ks and either retire or change jobs and move those Roth 401ks into Roth IRAs. That's the natural progression for most folks as they leave a place of employment, either retire or get another job and consolidate those assets into an IRA. An IRA stands for an individual retirement account, just so you can retain control, work with an advisor, whatever your story may be. So if you're moving Roth 401k dollars to a Roth IRA, first things first, you have to understand if that Roth 401k distribution, even though it's being rolled over, distribution is qualified. So step one is to figure it out if it's qualified. And if it's qualified, you're over the age of 59 and a half and have satisfied a 5-year holding period. That holding period begins on January 1 of the year you first made your contribution to the current plan, okay? If your Roth contribution is qualified, you can immediately withdraw tax-free the entire rollover amount. So that's the 401k contributions and the associated earnings inside that retirement account from your Roth IRA, right? So remember, you put money in, it grew. If you roll to a Roth IRA, all of it's totally tax-free if you've held that for 5 years and you're over 59 and a half, okay? But this is where things get a little hairy. Those dollars that are rolled over start making money, okay? As they're making money, if you did not have any Roth IRA at all previously, okay, that Roth IRA starts its own 5-year clock for those earnings. So you sit it there, it makes some money. Your prior rolled over contributions and earnings are tax-free, but the earnings that rolled over amount creates does have a 5-year window. You have to let that cook for 5 years. Even if you had your own, if you had a Roth IRA previously, you don't have to let it wait for 5 years, okay? So it's very important to understand that, hey, maybe if I'm 5 years out of retirement and I have some Roth assets, I need to talk to my planner about starting a Roth IRA, even getting $1 in there just to get that clock ticking so that I have full access to all those dollars. There hasn't been a whole lot of precedent, a whole lot of private letter rulings and things on this, but the onus is on you and your plan to ensure that you're keeping track of those dollars. So it's very important that as you roll things over, keep track of those pre-tax dollars or those Roth dollars, the basis as well as the growth. And then if it's not qualified, in that case, you can immediately always withdraw the tax-free contributions, but the earnings that attributed to that are not tax-free yet. So again, you need to be over the age of 59 and a half. So this gets to be very technical. It's not something that you want to screw up. So again, make sure you're getting the appropriate counsel, advice from someone. Pay attention when moving from a Roth 401k to a Roth IRA. Pay attention to, talking to your CPA or your planner when you're doing conversions, because it does create income and there can be some unintended consequences in doing so.
Yeah, Chris, I don't think you're going to be out of a job anytime soon, because I think it'd take a long time for artificial intelligence to figure out how all that works. And anyway, I think a lot of people would rather have you explain it to them than hear it from some artificial intelligence provider. So
well, I'm thankful for that.
Yeah, right.
I'm experienced, but I got about 2 more decades to go. So.
Let me see. I think there might be some additional topics talking about strategic Roth use in retirement, blending Roth and pre-tax income. We touched on this a little bit. Is there anything else you want to?
No, it's having, I call it a retirement income plan. So accumulation's one thing, distribution's a whole nother thing, right? So a lot of our clients, we are utilizing some of those pre-tax assets that have been there and up to a certain threshold of income. And then we're going to pull from the Roth buckets so that we don't creep up the tax brackets. And another thing, this is a Roth conversation, but don't sleep on just having brokerage accounts and assets that are also taxed at capital gains rates as opposed to ordinary income. So for my hierarchy of assets, Roth is number one. HSAs kind of fall in that bucket too. They're actually triple tax free. You get a deduction on the contribution. You can invest them and they come out tax free if used the right way. So Roth, HSA, and then you have your post-tax but taxed at capital gains rates assets that are flexible. Those are your brokerage accounts, and then you have your pre-tax assets, which can be very good. In some situations, but you just need to understand the hierarchy of the assets that you have and when you're taking them out and how you're spending them. You can't just, pull from one and then pull from the other. So it's very important to have a income distribution plan and making sure you're executing that and understanding the thresholds at where those dollars need to come out. Again, the goal is to retain as much of, work for a living. Want to keep as much of those dollars in your pocket, and paying attention to how you distribute assets is certainly important, because if you mess up, Uncle Sam's happy to take it. But if you don't, you can retain more to spend more, which allows you to either have fun, give, to whomever, kids, charities, whatever you want to do.
That's what it's all about, finding out
Yeah.
ways to improve your quality of life.
Yeah, it's just putting you in control and giving you options, right? Like allowing you to decide what you want to do with your money and not letting Mr. Government or Uncle Sam telling you what to do. So you can mitigate taxes quite well with some really good planning structure.
Yeah, yeah. Well, every time you and I talk about Ross, I always learn something new, and today's no exception. I've learned a bunch of new things, and also I'm still aware of all the things that I don't know.
Mhm.
So with that in mind, I'm going to see if there are any questions here. We have, looks like to start us off, we've got a question from Bill who asks about inherited Roth IRAs. And the question is the life expectancy table used by the person who inherits a Roth IRA, or can they do anything to close by year 10?
No, that changed. So they now have annual RMDs that started, but I would have to say it really depends on the inheritor, right? Like if sounds like it's a non-spouse inheritor, and then you get very complicated if you're inheritor of an inheritor. But it should be the life expectancy table previously used plus the RMDs coming out every year, and it has to be done by year 10. So I would say, unfortunately, I'd love to give you like a very solid answer, but devil's very much in the details, and happy to point you to the right table and have a quick discussion with you on what to use there. Most custodians, whether you're at a Vanguard or Schwab or with an advisor, will calculate that RMD for you and provide that. They're really good about doing so. But if you need some direction, just reach out, shoot me an email. Happy to point you there. But unfortunately, it tends to be more of a generic answer because the devil's really in the details there and who inherited it and when. That's the other thing. It depends on when you inherited it too. If it's prior to all these changes, you can still stretch it. The flow chart's a really good way to answer that because it spiders off in like 10 different directions.
Yeah, and I think this question highlights some of the confusion that might be out there because of this, the changes that occurred recently with what's called the Secure Act, and then a couple of years later there was the Secure Act 2.0. There were all these regulations from the IRS that explained it and gave more detail about what the changes actually mean. So you did have this regime, and I'm sure there's books and internet articles, blog posts out there that talk about the previous rules, and people have heard about the 70 and a half and time frames that they could stretch IRAs distributions over their lifetime. A lot of that's different now that it's for most people, for a lot of people, it's that 10-year rule. So you do have people that get confused because they've heard the old rules and maybe they don't know that it's changed, or they don't understand how those changes affected all the distributions.
Yeah, and unfortunately, there's a lot of information on the internet, and it's not always the most current or updated. So what you read out there might not always be totally accurate or current. So reach out to myself, CPA, and again, devil's in details. Happy to show you the right information and point you in the right direction. 10 years ago, I'd probably give you a hard answer, but the more I'm in this business, the more things change. I always go, just want to give me a second to look up the definitive answer on that one before I respond on camera.
So in terms of resources and places where you can look, I'm going to put the name on the screen here of this author that I like. His name is Ed Slott, and
he's the best.
You're familiar with him?
Oh yeah, I've gone to his conferences. He's honest to gosh, the IRA expert. So most of my knowledge and resources, and we pay a handsome fee to have access to having him answer questions periodically. He's got a bunch of, and I mean this in a very polite way, nerds that read all these private letter rulings and massive documents that the government puts out and give very complete answers cited for it. So, Andy, as you have legal resources, this Ed Slott's one of our resources, and he's an excellent person. So if you're ever scouring the internet and trying to get an answer to an obscure IRA question, I would highly point you to him as the number one resource online. Anything you see from his website is going to be spot on and accurate. So
and also he's an author too. So I remember years ago when I was first doing elder law, I read his book. I think it was called The Retirement Savings Time Bomb and How to Defuse It. And what's so great about it was that he explains this complex area in ways that are very accessible. You know, it's an entertaining book,
Yep.
and it gave me a great introduction to a complex field. And he's kept it updated. So even with the Secure Act revisions, there's a new version. I think it's called something like The Retirement Time Bomb Ticks Louder. But if you look up Ed Slott on, Amazon or some other, bookseller online, Barnes and Noble, you can find books by Ed Slott that I think are really good for a general audience, that, they can understand how all of these, how IRAs and 401ks in general work, but particularly with regard to Roths as well.
Yeah, it's really going to get you having that strategic planning thought on like, what assets do I own? How am I going to utilize them? And what's the end goal here? So obviously he's a CPA with a really good head on his shoulders and gives some wonderful ideas and concepts for people to grasp and understand. So.
Yeah. Okay. So let me see. I'm not seeing any further questions. Bill says thanks for the answer.
Yeah.
You're welcome, Bill. Thanks for attending. We appreciate that.
Happy to help.
But yeah, in terms of questions or if people want more information, you mentioned your website. So what is that?
It is retirerightfp.com. So I'll hop on there, and there's we probably have 70 or 80 flow charts under our FAQ section in our client center. They're all open and they're PDFs you can download. They're not password protected or anything. So feel free to hop on there, download whatever suits your fancy. There's some really good stuff on there. We're happy to pass along the knowledge, and if you see something you like and have any questions, shoot us an email. Happy to help.
Right, retirerightfp.com. And then it has all your contact information. So if people want to get a hold of you, I think it's got your email and your phone number on there.
Yep, most certainly. That's how I find everyone else's information these days anyways. Straight to Google. Sykes Elder Law. What's the phone number?
You're nobody unless you have a website.
That's right. It's valid. It's very much a validator.
Well, thank you so much, Chris. I really appreciate your expertise, and I'm sure everybody who's watching has benefited a lot from that. And anybody that wants to follow up on that and learn more, if you have specific questions or want an expert to help you with this, please make yourself avail yourself of Chris's expertise.
No, Andy, thanks for having me. You're a wonderful attorney. You've helped many of our clients with some excellent outcomes, and I plead everyone is just pay attention. Don't take the ostrich approach, stick your head in the sand. You can have some meaningful impact on your assets and your family's assets, consulting with an attorney like Andy and a planner and a CPA. The more you plan, the more you get to keep. So just pay attention. And there's little things that start early and big things that happen later. You can put yourself in a really, really good situation just paying attention. So get some advice, and there's some excellent people like Andy out there that are happy to provide that. So thanks, Andy.
Appreciate that, Chris.
Yeah.
Okay, well, we'll end the stream now. So thanks everybody for joining us, and we'll see you next time.
Take care.